Moody's recently announced it decided to affirm Spain's rating. The decision was based on several bullish developments, most notably the country maintains access to the bond markets. Right now I'm joined on the line by Alessandro Giansanti, Senior Rates Strategist at ING in Amsterdam. So Alessandro, many had expected Moody's to actually downgrade Spain to junk status. Now, were you surprised by Moody's decision?
Moody's decision for me was affected from the ECB decision to reopen the purchasing bond program to step in to support Spain together with the FSF, ESM. So doing that, they have reduced the risk that really Spain can refinance in the market. That has been an important driver of rating agencies in their decision to downgrade a country, a sovereign country, in the last period. So I think that's not a huge surprise, but maybe the surprise comes from the fact that this facility has not been initiated yet, so the Spanish government has not asked for support. So until now it's only in theory, it's not in practical terms. That's for me is the surprise that I was expecting Moody's to wait for more time for Spain to really ask support. There was a real risk in the market that junk bond for Spain will drive forced liquidation from investors because Spanish government bond will be out from some benchmarks. So now this risk is cooling, is coming down, and then we support further tightening of Spanish yields. For example, the 10 years now is trading at 5.40, can go easily in the area of 5%.
And US Treasuries were also affected by Moody's action. They fell in Europe yesterday as this cooled demand for safe haven government debt. Now, what are your views on the demand for US bonds, and how do you see US government bonds performing in 2013?
Every time there is relief in the crisis in euro, it has a positive effect on risky assets, so it drives U.S. Treasury bonds lower. But on the other hand, there is a specific factor due to the U.S. economy, especially U.S. economy is expecting to have subdued growth in the next years. For example, we expect the U.S. economy to have a growth around 1.8%, real GDP growth next year 2.1%. 2014, that is below what was the potential GDP growth in the U.S. in the previous years. I think that U.S. Treasury bond demand will be strong as long as Federal Reserve will stay with a very low yield with a quantitative easing program, and the Federal Reserve forecast that will stay on all the risks until the end of 2014. Coming for the demand for next year, this fiscal cliff will not be so much harm for GDP growth, and then when this fear will disappear from the market, I think that will drive really that higher levels, so will cool down some demand for U.S. Treasury bonds.
And foreign investors purchased 133.2 billion yen in Japanese bonds. What are your thoughts on the performance of Japanese bonds?
We expect Japanese 10 years to stay at low level, but on an upward trend, so to reach around area 1.10% in the next 2 years. And demand also is from foreign investors has been driven from the flight to quality flows that investors are more scared to buy euro bonds in the euro area, so they are moving to other area where they see lower credit risk. We have not very positive outlook for Japanese economy, so that will be supportive for Japanese bonds.
Also, Germany's 10-year government bonds fell a fourth day. The decline pushed the 10-year yield to the highest level in 4 weeks. Alessandro, what is your outlook for German bonds?
In German government bonds, they're trading at very low levels, partly also because the risk has been a safe haven from investors. And if you look at the 10 years, 164, based on our estimate, is trading around 35 basis points more expensive what it should be based on the current level of short-term yields and economic growth. But in any case, we expect to have higher yields in Germany, but they will be kept in the area between 2 and 2.2%, because to have really consistent sell-off in German yields, you need, first of all, the ECB starting to reduce the huge amount of liquidity in the market, because there is around 700 billion excess liquidity, and then they start slowly to move to more restrictive monetary policy. But that will not happen quite soon, especially for the next year. We have 10 years will be capped in the area of 2%.
And finally, what other interesting developments should we watch out for in the bond market?
We have also Italy that will benefit of better supply profile next year, where they have less redemption to cover. They are also relying on internal demand from retail investors. So that is news that they have placed around more than 10 billion in inflation-linked bonds. So that's so it's a reduced concern on their refinancing need, especially for a country that is issuing on average 200 billion of million long-term bonds every year. So it's a quite positive news. So we expect that Italy will continue to move tight and without overperform Spain in the medium term.
Thank you, Alessandro, for sharing your views on the bond market. Tomorrow we'll be taking a look at the performance of 3G10 currency pairs for Friday's targets and focus. But for now, goodbye.